I'm Mike Pettingell, CEO of Vizsla Royalties. If you're new to the mining sector or just curious about how companies like ours generate long-term value for shareholders, this video will break down one of the most important financial tools in the industry, mining royalties. A mining royalty is a financial interest in a mining project where the royalty holder, like Vizsla Royalties, receives a portion of the revenue generated from the mine, usually based on the amount of metal produced or sold. We don't operate the mine ourselves, we simply collect payments as production happens. This gives us exposure to the upside of mining without the operational or capital risk that's associated. The two most common types of mining royalties are one, a net smelter return royalty, or an NSR, and this just means you receive a percentage of the revenue after basic processing and smelting costs have been incurred. The second is gross revenue royalties, and these are paid on the total revenue before any deductions are made. These are also net profit interests, which are less common and depend on the profitability of the mine after expenses. So at Vizsla Royalties, our flagship asset is an NSR royalty, a 3.5% covering the production plan, and an additional 2% covering the exploration concessions on Vizsla Silver's flagship Pettingell project located down in Mexico. Well, why would a mining company give up part of its future revenue? Mining is capital intensive. To fund exploration, development, expansion, mining companies often sell royalties upfront before production in exchange for that capital. So it's really a win-win. The operator gets the funding that they require to push the project forward and get into production, and the royalty holder gets that long-term exposure to the mine's ultimate success. This model is becoming increasingly popular, especially in precious metals, where royalty companies such as Vizsla Royalties can build diversified portfolios with significantly reduced risk. So why do investors like royalty companies? Well, royalty companies benefit from scalability, lower risk, and leverage to the underlying commodity prices. So for scalability, once a royalty is acquired, there are no ongoing costs, no dilution in terms of raising additional capital. The lower risk, well, there's no exposure, as mentioned previously, to those rising input costs, fuel, labor. There's no permitting associated with a royalty company, and there's no operational risk whatsoever. There's also that leverage to the commodity prices where, the underlying royalty holder benefits from the production growth and the rising metal prices without ever having to lift the shovel. So at Vizsla Royalties, we're applying this model with a clear focus of building a high-margin precious metals royalty portfolio anchored by our flagship Pettingell royalty. As Vizsla Silver advances this world-class asset towards production, well, the 3.5% NSR royalty becomes increasingly valuable. We're just getting started at Vizsla Royalties with a strong foundational asset, disciplined approach to growth, and exposure to silver and gold at a time of not only rising commodity prices, but rising demand. We believe Vizsla Royalties is well positioned to become a premier royalty company in the precious metals sector. Thanks for watching. If you'd like to learn more, visit VizslaRoyalties.com or reach out to our team directly at info@VizslaRoyalties.com. Thank you.